So thank you again if you just joined in. I really appreciate y'all joining me here for our Money Counts Financial Literacy Series webinar on the time value of money. My name is Sarah Metzger, and I'm an associate with the Sokolov-Miller Family Financial and Life Skills Center here at Penn State's University Park campus. And so every other Tuesday, we come together to explore various financial literacy topics to expand our knowledge and enhance the skills we have so that we can manage our money more effectively. That's the big goal. This is a chance for us to really build a solid foundation for financial success and a lifetime of financial well-being. So with that said, I really do commend you for carving out time in your busy day to prioritize your own financial wellness. To live a financially fit life, we have to spend a little bit of time regularly learning, reflecting, and acting. So again, kudos to you for showing up today. Today also happens to be National Do Something Nice Day. And so I think by being here, you are definitely doing something nice for yourself. I also think it would be mighty nice of you to share what you learned today with a friend, or better yet, bring your friend along to our next webinar on October 19th, where we'll cover saving and investing. So in our last webinar, we reviewed the basics of budgeting and noted that saving is a core feature of a budget. Today's webinar is going to prime us to take a deep dive into saving and investing later this month, because today is all about interest and the time value of money. So before I launch into all of that, I do want to point out a few helpful tidbits of information. First off, you should know that I am joined on this webinar by one of our terrific student ambassadors, Lindsay. I will go ahead and give her a chance to introduce herself.
Hi, everyone. My name is Lindsay Dermota, and I'm a student ambassador with the Financial and Life Skills Center. This is my first year as a student ambassador and my first time helping out with the webinar series. So I'm very grateful to be joining you all today. Throughout the presentation, I will be in the chat feature answering any questions. So feel free to use the chat as much as you want to ask any questions, interact with each other, or to answer any of Sarah's questions. And I will also be dropping a link in the chat to our listserv, where we will be sharing any information about upcoming events that we have going on at the center.
Awesome. Thank you so much, Lindsay, and welcome in on your first webinar. I really appreciate your support here today. We're also going to have poll questions popping up on your screen periodically. They are anonymous, so please do share your thoughts, feel free. And also I want to point out that this webinar is being recorded. So we always record all our webinars and post them to our website for on-demand listening, because we realize that's a nice convenience for you. So if ever you are unable to attend, just head to our website, financialliteracy.psu.edu, and click on our Money Counts link at the top of the page to find any of the webinars you might have missed. And if ever you want to connect with us, simply shoot us an email at finlit@psu.edu. Or better yet, if you're on campus, you can come on over and visit us. We are located in the garden level of the Grange building, which is situated perfectly right next to the hub. All right, so that's everything I have logistically. Let's go ahead and get started. So we're here today to talk about the time value of money. The objective is really to demystify this concept and share how this variable impacts your financial goals. And speaking of goals, I always love this, I want to take a minute to learn a little bit more about who's in the audience and what kind of goals are currently driving your spending, saving, or investing habits currently. So what I'm going to do is I'm going to send a short poll out to you all and give you a chance to respond. You'll see that coming up on your screen here shortly. And so it's asking two questions. We'd love to know, what's your class standing or your current status? How do you connect with Penn State? Are you a student, an alumni, faculty, or maybe you're D, C, F, all of the above? I'm off on my lettering here, but maybe you're from elsewhere. We do at times have folks tuning in from elsewhere across the country, and we have at times even had folks tune in from other parts of the world, since this webinar is free. So take a second, if you could, let us know who you are and what are some of the financial goals that you're currently working toward. I'll give you about 10 more seconds or so before I share this out. And I want you to know that I always share out the responses that we get to poll questions because I believe doing so gives you a chance to see how your knowledge and experiences and the things that you value or you're working towards kind of compares to others. And seeing that comparison, I really do believe it helps us to feel validated, and it brings this community learning network even closer together, which is top priority for me. That's something that I really hold near and dear to my heart as an educator. So let me go ahead and end this poll. I'm going to shoot it back out to you. So you should be able to see it. And we've got a mix of Friends of Penn State. So we've got undergraduate students and we've got some staff or faculty joining in with us today. And among the crew here, we've got goals for traveling, food and dining. We have money goals related to our education, housing, shopping, a little bit of everything, which is just like so true, right? Like, how could we ever say we only have one or two goals that deal in money? So much involves money, and so many of the things that we enjoy doing or some of the bigger dreams we set for ourselves involve money. So all is good and well there. I really appreciate you sharing that. I don't know these goals specifically that you have within each of the categories, but I'm going to guess that some of them are short term and others are long term, but each is going to require time and money to achieve, right? So it benefits us to understand the relationship between both these variables and leverage that understanding to help us reach our goals, which is why we're here, right? The time value of money. It suggests that $1 today is worth more than $1 tomorrow. And so I'd argue that time in general becomes the most valuable resource we have in reaching our financial goals. So those of you who tuned in, those undergraduate students out there, you have a huge advantage of time. And even, staff or faculty, I don't want to assume anybody's age, we might all be young and have this benefit of time. We just have to figure out how to use it for good, right? And it's never too late. I should stipulate, it's never too late, right? Now, personal finance is personal, right? It always is. And reflecting on how you choose to use your money to pursue your passions or maintain whatever kind of lifestyle you've set for yourself is going to maximize your financial potential over a lifetime. We kind of grow up with this plan to go to school, get a degree, get a job, work hard, perform well, advance, and make more and more money, enough so that we can retire before we're too old to even enjoy retirement, right? But what if we could work smarter, not harder for our money? This presentation really emphasizes the importance of using the money that we have wisely by making informed decisions about our cash flow and kind of leveraging the time that we do have on our side for good. So by the end of this hour together, I really want you to be confident in your understanding of interest rates and some of the related key terms like APR and amortization. I want you to understand how exactly the time value of money impacts your debt and your investments. And I want you to figure out exactly how you can use this information to best manage your money, right? This is paramount. There are tools out there like amortization schedules that can help with this too. And I'll detail those resources a little bit later on, but you're just kind of figuring out where you're at, what do you need right now, and what's your plan moving forward, right? That's generally what I try to encourage my audience to think about. What jives, what's new, and what are your next steps? And I realize that sometimes we might need a little bit of time to digest these webinars. I usually say this, and that's true for, I think, learning in general, right? It could be a couple of hours, a couple of days. If you are a student, you can make a one-on-one appointment through Starfish to meet with a staff member or Finlit ambassador like Lindsay to figure out how you can take advantage of this element of time or all of this information and resources that we detail here today if you need. If you're not a student and you don't necessarily have access to meeting one-on-one with our staff, that's okay. We got you covered still, right? We have self-study modules on this topic and other topics that are accessible to anyone at any time time, all you need to do is visit our website. And, you know, as a student, all of our services come at no additional cost. So why not connect with us, right? Why not have a one-on-one, take advantage of our free resources online, and continue to attend these webinars and really move forward or continue to have forward momentum in this financial literacy journey that you're on, right? All right, good stuff. Now, if you have questions, I'll just do a quick reminder. Please, at any time, send those questions through the chat. Lindsay will address them. If I have a chance, I'll hop in and address them while we're going as well. Otherwise, we'll circle back to them at the end. And feel free to just share comments, even if you don't have a question, but you have an experience or you have some insight to share with others, please do so. Since we have kind of a varied audience group, we all have great information to bring to the table that is unique to our own circumstances, our upbringings, our backgrounds, and let's lean on one another and share that information out to be helpful if we can. I know I'd appreciate it. So let's get started. Let's set the stage and define this concept of the time value of money first off. And I'm going to do this using a question. I'm going to set the stage with a question here, a poll actually that's going to come at you on your screen once more. So I want you to imagine you are offered $1,000 today or $1,000 3 years from today. You have the option to take the $1,000 now or wait and accept later. Which will you choose? And as you're answering this question, if you've got a little extra time and you're really quick with the keyboard, drop a message in the chat why you chose the option you chose. What's motivating you to take the money now or wait? As you're kind of thinking through this answer, I want you to keep in mind this is not a trick question. We are talking personal finance, so your choice is entirely up to you. Okay, I'm going to end this poll. I'm going to share out the results back to you. And we weren't fully on one side or the other. Some of us are going to take that money now. Some of us would rather accept that money later on. And I'm taking a look at some of our rationales, why we, opted the way we did. Okay. And some of you, your thoughts are kind of in line with where I'm going here, right? For those of you who opted to take the money now, you may have been thinking about bills that you have to pay, the usefulness of this money coming at you in the moment, right? Rent's going to be due again in a month, or you've got some holiday shopping you want to get a leg up on, and $1,000 right now is more than enough to cover everything that you need on the wish list, right? But some of you are thinking about taking that $1,000 now because it's a fantastic opportunity to invest. And I would agree. If we take, let's say, for example, if we take that $1,000 today and we invest it in a single investment account at 3% annual interest and reinvest it for the next 3 years, we will end up with about $1,093. Ultimately, we're going to have more than the original starting amount. And I think that's where some of you were thinking about this, right? This difference, it's known as the time value of money. Because remember, like I said earlier, $1 today is worth more than $1 tomorrow. Now at the center, we're super huge advocates of saving early and often. And when it comes to investments, the same can ring true. The sooner you put some money away into a savings or investment account, the better your return is going to be. This can help really position you to reach the goals that you set for yourself on the timeline that you want. So thinking about what matters to you, this time value of money can really propel you in a positive direction towards reaching some of those financial goals. Now on the screen, you see a visual representation of the time value of money. And to understand this concept, it's essential to understand its related terminology, including present value, future value, interest rate, the number of periods, and the payment amount. So the present value is your current starting amount. It's the money that you have in your pocket right now and you want to invest. Could be that $1,000 you just got, right? So you can see in the image that it's a relatively small amount and the clock starts the minute you invest it. So you can see that your original amount of money is growing over a number of periods. So let's say each block here is representing 1 year, 2 years, 3 years, 4 year, right? Now, at the end of the year, you will have, so if we go back to the first year, at the end of the first year, you will have your previous amount plus any interest. Now, how much your money grows is based on the interest rate, which is usually stated as a percentage value, like 3%, for example. And as you move into year two, you're going to reinvest your previous amount, and that amount is going to continue to grow into year three, and the cycle continues to repeat, right? So any of the interest you make, you're reinvesting that year after year after year, and you're seeing your money start to grow, your funds grow exponentially over time, right? And now at the end of the period, which I should say could also be days, months, quarters, or years, right? Like I had mentioned, your investment results in the future value. So this future value is bigger than your present value, hence why it can be so beneficial to take the money now that's being offered to you and invest it. Now, I know for many college students, planning for long-term investments isn't necessarily on the radar. We've been told not to delay, or maybe we're sort of familiar with investment apps like Acorn or Robinhood, but in general, it might not be a top priority for us right now. We have a lot of competing priorities, and our brain space is kind of being, that real estate is being taken over by some other interests. And I understand that. But I do hope that this visual can serve as a catalyst that motivates you to begin exploring the benefits of saving and investing really early on. So I want to give you another quick, more concrete example that highlights the time value of money too. So if I invest $1 for a year at a 6% interest rate, then I will receive $1.06. I earn 6 cents, thinking of the movie right now. I earn 6 cents based on my initial investment and the interest rate, as well as the time period of my investment, right? Now, I know for this example, and this is, I'm thinking about anybody who's considering money amounts, right? I know for this example, earning 6 cents in interest over the course of a year from $1 investment might not seem so spectacular, but when we make a conscious effort to save money and grow a larger sum to invest, then the amount we earn in interest really starts to get pretty exciting. And this is especially true when we're talking about compound interest, which I'll get into in a little bit. Our small investments can really start to add up. It's like this snowball effect. So something I want you to keep in mind, though, is that this concept of the time value of money impacts not only our investments, but also our debt. So saving our money and paying off our student loans and staying out of debt now is definitely worth more than planning to do these things sometime in the future, and you'll see why. So many of us, I want to believe, are familiar with interest rates because our credit cards, because we have credit cards, we may have student loans or a car loan. It's really important to know that interest can be a charge or it can be an income depending on whether you are borrowing money or investing money or lending money, right? So let's say, like, on the one hand, you apply for a $150,000 loan at your local bank. The bank approves your loan, but while it waits for you to repay that loan debt, the bank can't use that 150 grand for anything else. So it would seem fair that you would pay the bank something extra for inconveniencing it, right? On the other hand, when you go to the bank to deposit a $3,000 paycheck, you are, in a sense, loaning the money to the bank, which you can't necessarily use either while it's being held, but the bank can, right? Kind of flip-flop in this case. So again, it would seem fair for the bank to then pay you to use your money, right? In a nutshell, when we're talking about interest in both of these examples, interest is really just the amount that's charged for the privilege of using someone else's money. Now, there are several types of interest rates and 5 to be familiar with, including what you see on the screen here. So we've got simple interest, compound interest, fixed interest rates, variable interest, and mixed interest, right? Now, knowing how each interest rate functions is really going to help you make informed decisions when it comes to your saving, spending, and investment habits. We're going to take a look more closely at each on the next couple of slides. So simple interest is the most straightforward and uncomplicated way to calculate interest. To do so, you're going to multiply the principal amount, which is either the original investment or loan amount, by the interest rate and time. So that'd be P times IR times T, principal times interest rate times time. Now, if you don't want to do all these calculations yourself, don't sweat it. You don't need to. You could use a calculator or even have Google simply perform the calculations for you. We are so very fortunate to live in this age of convenience. And so if you need a little bit of assistance with the math, that's perfectly fine. Get whatever help you need. But let's think through some examples here about simple interest. 1% annual simple interest would credit $1 for every $100 you invest year after year. Right? Let's say if I invested $1,000 for 10 years at a 5% simple interest rate, my return is going to be around $1,500. In other words, 5% of $1,000 is 50. Multiply 50 by the number of periods, in this case 10 years, and it totals $500. So this $500 is added to my principal balance, which results in my total return of $1,500. Now, many personal loans, student loans, and car loans, they apply these kind of simple interest rates. So let's also look at an example of simple interest on a student loan. This might be very relevant for some of us in the audience. So let's say I take out a private simple interest student loan of $18,000 and the annual interest rate is 6%. I'm planning to repay this loan over 3 years. I would multiply the principal amount, which is $18,000, by the interest rate, which is 6%, by the number of periods, which is 3 years. Now that's going to total to $21,240, the total amount that I'm going to end up repaying to my loan servicer. And doing a little subtraction is going to show that I'm ultimately paying $3,240 in interest. That's the cost that I incur for borrowing that student loan amount, right? Now, simple interest, we should know, is often calculated daily. So it really benefits folks who pay their bills or loans on time or even early each month. In the case of my student loan example that I just gave, if I can pay early every single month, my principal balance is going to shrink even faster, and I'm going to pay off my loan sooner than originally estimated, which is what we all kind of want, right? We're all shooting for that. So keep that in mind when it comes to simple interest. Now, compound interest, this is what really shows the time value of money. It's different from simple interest because it accrues and it's added to the accumulated interest of previous periods. So in other words, it includes interest on interest, right? Think back to our visual a few slides back, that kind of mountain climbing effect, the upward snowball. So compound interest is always going to pay more after the first pay period. And most bank account or bank deposit accounts, I should say, tend to use compound interest. So chances are you probably have a bank account currently that is utilizing compound interest. And how much your money grows in that account is based on your interest rate plus your current balance and the number of times your bank is paying interest or compounding, right? So for example, let's say I want to invest $1,000 for 10 years at 5% interest compounded annually. My investment is going to yield $1,628.89 by the end of 10 years if I don't make any additional deposits. Now, keep in mind that any extra contributions I make to that account during the 10-year period will also earn interest and be compounded annually too. So if we're talking a savings account, banks reserve, keep in mind, banks reserve the right to raise or lower the interest rates at any time. So if you're looking to earn compound interest at a consistent rate for a specific period, you may wish to consider a different kind of savings account, right? You might otherwise not end up with your yield as you anticipated if those rates are kind of fluctuating over time. If you're looking for something that's a little bit more consistent, you may wish to consider opening a certificate of deposit, also known as a CD. So these types of savings accounts have fixed rates, which we'll talk more about in an upcoming slide, and terms that are also fixed, and they usually offer a higher interest rate in general than a standard savings account. So something to keep in mind, a consideration though, CDs don't give you regular access to your money like a savings account does, and you might be penalized for accessing your money before the term of the CD ends. So as you're kind of thinking about, ooh, what are the best accounts out there for me that have compound interest that are really going to give me the best return on investment for my money, you got to look at the rules with those accounts too. And so that's just a quick note about CDs. Now, when we're thinking about borrowing, because remember, interest works in our favor and sometimes against us for investments, or in the case of borrowing. When we're talking about compound interest working against you in the sense of borrowing, when you borrow money, you accrue interest on any money that you're not paying back. So if you don't pay the interest charges within the period stated in your loan, whatever that may be, they're capitalized or they're added to your initial loan balance. And after that, future interest accrues on the new larger loan balance. Now, I mentioned that most student loans typically have simple interest rates, and that is true. So you wouldn't think necessarily to worry about compound interest and student loans, but there may be times where student loans do have compound interest. It's essential before you go and take out a student loan, or really any kind of student loan, that you know what type of interest comes along with it so you can make plans for repayment accordingly. Now, when it comes to compound interest as part of an investment or a loan, the math can get a little bit complicated, right? And I know I think I see a message coming through the chat. Hopefully Lindsay has a minute to do a little bit of typing and help work through that there too, that math. Compound interest is not super straightforward in working out the math, right? But luckily, and this would be a personal preference for me, there are a lot of online compound interest calculators out there. You got the calculator on your phone to kind of work that out if you need assistance. The U.S. Securities and Exchange Commission even offers one on its website. So if you go to investor.gov, you can pull up a compound interest calculator very quickly if you so need. I'll definitely come back to this math at the end, just to kind of work it out a little bit if Lindsay's not able to get to it right now. But definitely I want to make sure that we work through some of that before we go here today. Now, when it comes to fixed interest rates, they have the same rate throughout the period of the loan or investment as you can imagine, right? Fixed meaning it's unchanging. Mortgages and car loans generally offer fixed interest rates, which can be nice because you can potentially avoid the risk of that mortgage or loan payment significantly increasing or fluctuating over time. Now, opposite of fixed interest rates are variable interest rates, which I'm going to get into, but I want to maybe preview some of the differences between these two types, because they kind of, when you're talking about one, you can't really help but talk about the other, right? Fixed interest rates benefit borrowers because they offer predictability, like I mentioned, right? Not a whole lot of fluctuation, which makes it easier, I believe, to manage a regular budget. So if you're really into keeping a set budget every month and you like your pie slices to not wiggle around and adjust too much, and you want to keep things highly organized, if you've got a fixed interest rate on a loan, you're gonna see a consistency in your budget that maybe makes you kind of happy, right? The rate is static, and so you can more easily calculate the long-term cost of borrowing too, which is nice. But on the flip side, with fixed interest rates, the loan products that have fixed interest rates might come at a higher rate than variable interest. And so it might cost more overall to, for a loan product that has fixed interest. So something to keep in mind. Now, if you're interested in this fixed interest, I got to stop saying interest so much. It's going to be hard for this presentation, right? If you have interest in this, it was piqued by this slide, be sure to check out our self-guided learning module on saving and investing and mortgages. We'll talk about saving and investing in 2 weeks, but if you're also thinking about mortgages, because I'm mentioning it here, we do have a self-guided learning module that you can access. And this is a really far away plug, but we have a webinar on mortgages coming up later on in the spring, so stand by for that too. So variable interest rates, they are obviously different from fixed interest rates, like I said, and similar to what you would expect with their name, the rate does fluctuate over time. So sometimes these rates are referred to as adjustable or floating rates for that reason, and they vary based on an underlying benchmark index that is changing periodically with the market. So that's known as the prime rate, which is the prime rate is the interest rate that commercial banks are charging like their most credit-worthy customers. And that rate is set forth by the Federal Reserve. And so, the big takeaway is variable interest rates are changing over time. They just kind of vary and ebb and flow with the market. Now, credit cards can utilize variable interest rates, and these rates can change without advance notice to the credit card holder. I think that's really important to point out. So credit cards are using these, oftentimes using the variable interest rates, and the credit card issuers do not necessarily have to notify you of any changes. The terms and conditions of your credit card agreement will describe how the interest rate is calculated. So I can't stress enough how important it is to not skip over the fine print as we sometimes do. Credit cards, they might also utilize fixed interest rates. I should say that not all credit cards are variable interest rates. Some of them are fixed, but we can't control the type of interest rates our credit cards have because ultimately it's the credit card issuers who are determining that. But we can control the amount of interest we pay by keeping our credit card balances low and paying off those balances in full and on time each month. I think, I was thinking about this slide, and I think that this is a good opportunity to also mention the newly popular buy now, pay later apps that have been popping up all over our favorite online shopping sites. I don't know if you have noticed this recently. I feel like every time I hop online, I'm seeing more and more. These are apps like Klarna, Affirm, and Afterpay. There are a few others, but those are just like big three that I feel like I'm seeing all the time. So the way that this works, these buy now, pay later apps, it's like you would think, right? They offer you a way to pay for your purchase over a series of monthly installments. And they're oftentimes, indicating that by utilizing their service, it's quote unquote interest free. We're talking companies that are acting like credit cards, but they're advertising different rules, or that they don't function quite the same way when they say, well, this is interest free, right? It's really important to do your homework first before using these apps though. They may charge interest right off the bat, and they might tell you that like a credit card would, but they might offer these interest-free periods too, and that's probably something they're going to talk up even more. And I know that sounds great, right? Like paying $25 installments over 4 months instead of coughing up $100, in the moment to make a purchase sounds great. But if you don't make your payments on time, or you fail to pay your balance in full before the quote unquote interest-free period ends, you'll likely be hit with really big late fees and an exceedingly high interest rate. And of course, they're not necessarily advertising that to you because that's not super appealing, and they want you to utilize their apps and their services. So just kind of keep that in mind. It maybe is not as clear as it would seem face value, and we got to do a little research here. And I should point out too that in a similar consideration with these buy now, pay later apps, they don't always report on-time payments to the credit bureaus, but they do report late payments. So using such apps might not improve your credit score, but rather it might only hurt it. And we should have that kind of information in front of us before we make a decision to use one of these buy now, pay later apps, right? Kind of weigh this all out for yourself before you move forward. Now, last up are mixed interest rates. So loan products with this type of rate apply both a fixed and variable rate during specific periods of the loan. So usually the fixed interest rate is applied during the initial period of the loan, which is something like 3 to 5 years, depending on the length of the loan overall. And at which point, once that initial period is up, the variable interest rate would kick in and apply to the remainder of the loan. So in the case of mortgages, we call this an ARM, an ARM, or an adjustable rate mortgage. If this is where you're at, your age and stage in life, you may have heard of this. And it may be more beneficial for you to opt for an adjustable rate mortgage over a fixed interest rate mortgage, especially if you know you're only going to have the loan for a few years due to, let's say, planned relocation, for example. So there are important considerations to make here. How does this apply to me as perhaps a future homeowner? What are the next 5 to 10 or 15 years of my life going to look like, right? And how is that informing my choice of loan or interest rate? So let's step back to student loans for a minute here, though. If you have a federal student loan, excuse me, dispersed anytime after 2006, it has a fixed interest rate as determined by federal law. You might also have a fixed interest private student loan too. Student loans can be refinanced, meaning a new private company, usually like a bank or a credit union, but this could also be an online lender too, excuse me, they pay off the loan that you wish to refinance and you get a new loan, or when they do pay off, I should say, when they do pay off the loan you wish to refinance, you'll get a new loan with an interest rate that's tied to your credit, your income, and other factors, which was not the case initially if you took out like a federal student loan where those rates are just kind of set the same for everybody, right? Now, if you have really good credit, excellent credit, a stable income, and the loan, your current loans have a high enough interest rate that you'll benefit from a lower variable rate from refinancing, it may be an option for you to consider. I'd say it's helpful to monitor kind of the movement of interest rates and their projected forecast before making such decisions. You really want to do your homework before deciding that refinancing is an appropriate move for you. Now, as you think about all these varied types of interest rates, consider the cost of borrowing and look at all of the accounts in your financial profile, because it's important to be aware as you do so of this factor known as APR, or annual percentage rate. So if you're kind of taking stock here, be aware of this particular term and what it all means and how it applies to you. So it's referring to the annual rate of interest that's charged to borrowers. And it's typically expressed as a percentage, as interest rates are in general, but it differs from your account's general interest rate in that it's including the yearly cost of borrowing for those funds. So APR, in other words, it reflects the true cost of borrowing because it includes any fees and charges, right? Now, what does this matter? Like, why ought we, understand APR? So APR provides you with a bottom line number that makes it easy to compare loan products and credit cards, right? So you're able to find the best rate. And APRs, this has to be disclosed. Like, all of this information has to be available to you to have and to make decisions with. So if a credit card company were not to disclose that, that is illegal. They can't do that. They have to let you know this information, right? And when you have this information, you can compare APRs between the different mortgage lenders if you're looking for a home loan, or credit card companies, or what have you. And in general, the lower the APR, the better, right? So as we're trying to do some comparison shopping, this makes understanding APR essential if you are in the market for getting a new credit card, or if you're looking to take out a loan. This becomes an easier task when you're empowered with this information, right? Now, earlier in the presentation, I pointed out various accounts that utilize compound interest. Savings accounts, CDs, I should also mention 401ks utilize compound interest, as well as loan products like student loans, car loans, and mortgages. Compounding interest, it rules the marketplace, like for better or for worse. So when you're looking at an APR, it's important to also consider what is known as the daily percentage rate, because a lot can happen in a year. How you use your credit can change, of course, and lenders want to kind of account for that. So it's important to ask your lending institution how they're compounding your interest. I told you before, they're required to tell you the APR, but it may be up to you to ask, right? They might not necessarily make that information super written big font in front of us, right? So ask, is the interest assessed daily? Is it compounded daily? Is it assessed monthly? In most cases, when we pay our bills, we're doing it monthly, but the annual percentage rate is assessed on a daily basis when we're talking like credit card bills. So how do you figure out how much you owe each month and each day, right? You're going to take, and we've got this math going here, you're going to take the annual percentage rate, the APR, and divide it by 365, right, the days in the year, to get your daily percentage rate. So you're going to look at this daily percentage rate for any accounts that are compounded daily that you have. Interest charged daily typically accrues faster than interest charged monthly or yearly. So something for us to really be aware of, right? If we have student loans, our loan services are usually going to offer some sort of calculator online to help us figure out the daily dollar amount that interest accrues on our accounts. So for students here, or really any of us that have student loans, right, you have a fantastic opportunity, students especially, have a fantastic opportunity to log into your accounts online to stay on top of your interest, and see and manage this concept of the time value of money firsthand. Try to stay on top of everything as best you can, this daily interest that's building up, by paying off the interest monthly while you're in school if you can. We would always advocate for that as a center and help students figure out a plan for themselves to be able to make those payments right now before graduation if possible. That might require you to reassess your budget and do some rearranging with your funds. And if you need help with that, that's totally fine. Staff like myself or our ambassadors like Lindsay would be really more than happy to sit down with you and help if that's what you want to work on right now, right? Now, for installment loans like student loans and car loans, so still kind of keeping on with this, a useful concept to understand is amortization. So even as someone, and I'm going to talk about myself personally for a second here, even as someone who had a little bit of personal finance education in high school, this was a term I only became familiar with late in college. So it's okay if it's new to you too. Chances are you probably understand the concept or are familiar with the concept to a certain degree, but maybe not the word itself, right? So for loans that are amortized, they have consistently made monthly payments. So your amount that you pay each month is the same. A little of your monthly payment goes first to satisfying the interest you owe, and a little of your payment goes to the principal balance that you borrowed. So amortization is really just a fancy word to describe how you pay a consistent monthly amount, and that amount is then just kind of split between the principal and the interest. Now, if I have regular monthly loan payments, why should I be familiar with this? Like, why does this necessarily matter? Seems like it might be an extra step or some extra effort to keep in mind, especially if I'm already pretty hands-off with my loan payments. If I've set up automatic pay each month, like why do I have to be super familiar with this? How does it help me, right? It helps us understand ultimately how our payments are being applied to our loans, and it allows us to stay on top of our repayment and motivated at the same time. So paying a little extra toward our loan balance each month, it's going to help us tackle the overall amount, because the little extra that we pay is going directly towards lowering the principal balance. And understanding this concept of amortization ensures that you know when your loan ends, and that you're definitely making headway in reducing the loan to zero as fast as you want to, so that you can move into living the debt-free life that you desire, free of student loan debt, free of car debt, free of any other kind of personal debt, whatever it is, right? There's a really terrific visualization on this slide for you to take a look at. So each square that you see on the screen here, we're going to say it represents one period. And in this case, we're going to go with equal monthly payments. So on the left, you see that in your initial payment, a fair amount is going towards interest. Maybe something like a 40-60 split you see here, right? Over time, though, as you continue to make payments month by month, more of your payment goes to the principal balance and less to interest. So why is that switch happening, right? Well, let's take a look at the same concept in a different kind of visualization here on the screen. And so if we need to maybe see the dollars, the actual numbers, this might make more sense, right? On the screen here, we see a sample amortization schedule. You see each of the 12 monthly payments you'll make. So here's your payment amount on the left, or sorry, your payment on the left, the payment amount in the second column, right? And you see that it doesn't change. Same monthly payment month by month by month, right? However, the amount of your payment that goes towards the principal balance, it progressively increases, while the amount going towards interest is progressively decreasing, right? So what's happening here is that while you're decreasing the overall principal amount of the loan, the overall interest that's being assessed is also decreasing, because it's based on the unpaid balance, which you would see over here, right? I want this slide to really serve as a frame of reference for you as you're looking at your own loans, student loans or otherwise, and you are begin working out a plan for repayment if payment hasn't already started. Or even if it has, you can get organized with a schedule like this, right? If you have one on an Excel file, something that you can kind of play around with, right? That's really helpful in determining just how long you wish to carry a loan. You can kind of make those long-term projections for repayment using a tool like this, right? You can figure out the period, the number of times you're going to expect to make payments based on your payment amount, and you can kind of help build a budget for yourself around a schedule such as this. They kind of go hand in hand here, right? You can see just how important it is. And how long you choose to carry a loan is ultimately going to determine how much you ultimately pay for it in the end. So having a schedule like this, can't stress it enough, very, very helpful for some of these long-term planning purposes, and just to really be able to make sense of what's going on with my payment, what's happening here. Now we offer a downloadable schedule, an Excel file schedule that I would encourage each of you to check out. It's available on the resources tab on our website, especially if you have student loans. And especially, if you're a rising junior or senior who's approaching graduation and future loan repayment, this is a tool to play around with and take a look at prior to graduation. Now, as we kind of experience the ebb and flow of our finances, there are going to be moments that require us to make financial decisions that prevent us from investing and taking advantage of the time value of money. That much is true, right? But of course, money can only grow if it's invested over time and it's earning a positive return. And so anything else, money that's not invested, is losing value over time. But of course, for many of us, what if my debt is just looming so large over me, though, that I don't think I can afford to make investments right now? What if I just have all of these other competing money priorities, particularly debt? What do I do? Debt's going to continue to grow over time, after all, right? If I'm not actively working to pay it down, so shouldn't I be focused on that? How should I ought to be using my money that I have right now in front of me to take advantage of this time value? Negotiating these financial options and making decisions that could delay our chances to invest, this is known as opportunity cost. It's like this old saying, you can't have your cake and eat it too. So, for example, you might decide it's best for you to pay off some credit card debt, build up your emergency fund, or invest in a side business rather than investing your money, then waiting to collect interest. When you have any kind of debt, you are making a time value of money calculation. You may have decided that whatever you purchased on your credit card was more valuable than a larger amount of future dollars that you could have had you invested that money elsewhere into an account, right? Now, before you decide to continue swiping your credit card or spending your money otherwise, ask yourself these three questions if you're trying to figure out the opportunity cost and you know, kind of rationalize with yourself how you want to be using the money that you have right now. Is this item that I am potentially going to buy worth the extra payments plus interest? Is the opportunity cost of giving up the potential earning of interest acceptable for my goals? Is this the right move for me right now? And is acquiring the desired item on credit more meaningful to my financial freedom and security than saving and investing? So just really reckon with yourself some of these questions, go back and forth with yourself. Remember, personal finance is inherently personal, as is financial literacy. So level up in that space of reflection to answer these questions for yourself. Now let's step back into investments for a moment. The time value of money, because we talk so much about loans, let's step back to investments, right? The time value of money is a useful concept here because we can use it to compare investment alternatives, right? When we're kind of deciding what do we want to do with our cash. Now, overall, my aim was not to teach you a series of interest rate formulas to memorize today. There is an aspect of mathematics that comes along with this, but it wasn't my goal to be super heavy on the math and the formulas, really, particularly because there's so much technology out there that can complete these calculations for us. My goal in breaking down this concept was to help you understand the correlation between present and future value, right? So that you can figure out exactly how to maximize the money you have right now through investment. Now, I think it's safe to assume for most of us, we probably all eagerly anticipate our future retirement, right? Maybe we're really close, maybe we're kind of far off, but nonetheless, we're probably excited about that period of our life. And we envision it to be relaxing, enjoyable, free from the burden of money-related stress, just like, nice, right? It's never too early to begin planning for retirement. And I hope that I've made it clear through the presentation that the more time we have to get ready, the better. So as you're kind of getting yourself situated for that, ask yourself these questions. How much money should I invest now to reach a certain annuity in the future, right? That payout. And how much money should I expect to receive if I invest a predetermined amount right now? We don't want to outlive our savings and investments in retirement. Like that's probably a worse nightmare for some of us. So it's really important to figure out the answers to these questions as best we can as soon as possible. So when it comes to the time value of money calculations, you can figure out pretty much, any of the unknown variables or a unknown variable, I should say, so long as you have any of the four of the following. So this is going back to one of our original slides. If you know the interest rate, the number of periods, the payment amount, the present value, you could calculate the future value. Or if you know the future value, the present value, the number of periods, and the interest rate, you could calculate the payment amount. Basically, having any four of those five is going to allow you to calculate the unknown variable that remains, right? And that's this element of math kind of coming back up, but I want you to know conceptually that that's possible. And so you can answer these questions with some of the varying or different variables you have in front of you, right? You can kind of complete that formula. So here's the bottom line. Ultimately, the longer you wait to consider these calculations and the longer you wait to start investing, the more money you will ultimately need to reach your financial or final financial retirement value goal. Sorry about that. Early and often, that's what we always say. That's the bottom line here. And one of the biggest points I want to get across to you, that time is on your side, so use it. I think this last visual really drives that point home. So you can see two individuals here. We have an individual age 25 on the left and a person aged 35 on the right, and they both begin making $5,000 annual investments towards their retirement, right? Over 10 years, the 25-year-old invests a total of $55,000. So you can see that between the ages of 25 and 35, right? And so that annual return, I don't know if you can see that at the bottom here, I'll kind of circle that. This annual return of 8% is going to yield for the 25-year-old by retirement a final retirement value of over $615,000. So the 25-year-old made a total investment of $55,000 for a 10-year period and had a return of $615,000. Now the 35-year-old, on the other hand, they are investing that same amount, $5,000 annually, same annual return, 8%. But even after investing that same amount for 25 years, which is a total investment of $130,000, this individual still only ends up with a final retirement value of just over $431,000. So really, if it wasn't clear before, I hope it is now. The impact of time is quite clear. And it's quite serious, for better or for worse. Let's leverage the time we have for good, right? Now, if you are a student here at Penn State, the Financial and Life Skills team is more than happy, like I've said before, to help you work through any questions that you have about the time value of money, or credit cards, student loans, investments, long-term financial planning in general. I know that this particular presentation is not always the easiest to digest right away. And so I'm going to welcome you to come talk with a member of our team to kind of debrief this a little bit more, or tap into some of our resources online. If you are interested in a one-on-one appointment, you can connect with us through our website and book through Starfish. You could book with a full-time staff member or any of our student ambassadors, right? So if you'd rather work with a peer, you can do that. If it's convenient for you to meet online, we offer virtual appointments, or you can come into the office. That's perfectly fine too. And if you want to do some of this revisiting, this debriefing with yourself, we do have resources that you can access on your own, like our self-paced learning module that I pointed out earlier. We have a savings and loan repayment calculator link on the webpage, and we also have that free downloadable amortization schedule for student loans, as well as a separate resource for debt management. So we've got a lot to offer, and we hope that you will take advantage of it. You can see it all at our website, financialliteracy.psu.edu, or if you need to, you want to reach out to us directly, you've got a very specific question you want an answer on ASAP, just like I said at the very beginning, shoot us an email, finlit@psu.edu. We would really love to hear from you. But that's everything I've got for you today on the time value of money. I want to thank you all so much for joining us, and say that I am so happy to continue to have you visit, especially those of you who have been with us from the start of the semester. Thank you so much for joining in. I hope that you will see us again in 2 weeks for our webinar on saving and investing. That's going to be on October 19th at noon. Now, Lindsay, I think I think she just did. She's going to share a link with you to a survey. We would love to get some feedback from you as well on this webinar. So please, if you've got a few minutes, fill that out. And if there are any remaining questions to be answered in the chat, we're going to go ahead and do that now. Lindsay will get a head start, and I am going to bring up the SELC QR code for any of the attendees that need it. So just hang tight a minute. And if you are going to roll out here, thank you again, everyone, so much for joining, and have a wonderful rest of your week.